Let's see. Okay, we are live. Excited to see you guys starting to jump on right now, and some of you guys are on live. I know some of you guys are watching the recording. As always, even if you're watching the recording, feel free to always ask questions in the comments below, or even just make comments in general. For those of you that are on live right now, because we are going to a great topic, very timely, especially with everything that's going on right now. This should be your number one financial concern, assuming you actually have money. If you don't have money, then obviously that's your concern. You're just trying to figure out how to live day to day. But for those of you that have money in the stock market, this is something you need to watch. So go ahead and say hi in the chat. Just so you're aware, anytime you say hi, make a comment, which I encourage you to do, ask questions along the way, because naturally it takes me like a minute to see your comments or your questions. So be sure to do that. So be sure to say hi. Nice. All right, we got one hello that already came in right now, so great to see you as well. Just so you're aware, again, ask questions along the way, make comments, feel free. I want this to be interactive. You can even see here, I'm in a hotel. I'm actually in Texas right now at a real estate conference, and so I took a step out so we can talk, because this has to be suggested, and I want to make sure you guys win when most Americans are about to lose big time. And so I'm going to give you the solution of what you can actually do to do that. All right. Now, let me ask you a question. What if you could go back to 2011 and you had the cash to buy anything you wanted? Anything. I'm speaking specifically for investing, right? Would you do it? What would you buy? And go ahead and put that in the chat. For those of you guys that are on live, I know more of you guys are jumping in right now. What would you buy with that cash? If you go back to 2011, would you be putting more money into the stock market? Would you be buying real estate? Would you be, buying Pokemon cards? I don't know. What would you actually be buying? What could you do if you had all the cash to buy or invest in whatever you wanted? I know some of you guys, there's probably gonna be somebody's gonna say like Nvidia or something like that, which I don't blame you. Some of you probably might even say Bitcoin, because 2011, actually Bitcoin was pretty cheap, hindsight 2020. All right, we got somebody who said infinite banking policy. Yeah, I know. How many times I've heard people say if they could go back 20 years, property. Absolutely. That was the low of the property. Got another one for infinite banking as well, right? Definitely. All those things are awesome, awesome things. Now, remember, this is the key we want you to remember, is like if you had the cash to buy everything, because I know in 2011, I didn't have the cash. I don't know if you were the same as me. Maybe you were doing great, but I've had so many people that I've even interviewed on our Money Ripples podcast that said, man, in 2011, I had cash because I had, a very good paying job or whatever it might be. They hadn't invested anything yet. They hadn't bought real estate. They hadn't done anything with the stock market. They just had cash. And then they ended up making multi-millions because of the timing of the market, right? And I wonder what we're going to have happening right now, especially now we're in 2025 going to 2026. Could there be something around here? So I'm going to talk about what's the current market danger that's happening right now at the end of 2025. Where can you keep money safe right now? And could you even keep your cash liquid and invest it at the same time, allowing you to get really a double dip, kind of a good offense and defense, that 1-2 punch. Now I'm going to ask you a question for those of you on live. Again, if you're watching the recording, you're welcome to comment too. Which phase do you think we're in the market cycle? Now, if you can see right here, I know on my screen it's kind of small, but if you can see right here, there's like these 4 different phases. But as the markets go, it kind of moves along. Most of the smart money is going in early on, right? They're putting that money in, where it's going in as the market's kind of riding. And then you start to see the awareness phase. People start to realize maybe we are in an up market. And then pretty soon it gets into the mania phase, right? Where it just takes off, just astronomical numbers. That's when you really see money going in. And you notice, like it says right there, about partway up, I know you can't really see where I'm pointing, but if you're on the right-hand side, as you're moving up past enthusiasm to public, right? Because institutional investors are back there. The smarter money's in the back. Public money starts going in at the mania phase. And it starts riding high. And then you have what's called a little bull trap, right? Where it pulls back, but then it starts to pop back up, right? Now, it even gets to the point where it says there's this new paradigm, right? It's in euphoria. But then it pops back up. Then we're back to normal. It's okay. It wasn't really going down. And that's right before it goes down. Now, I'd love to hear in the comments, where do you think we're at right now? Based on what you're seeing in this picture, what phase do you think we're at? Do you think we're in the phase where there's, a lot of people are denying what's going on right now? Like, meaning like they don't think it's an up market. I don't know if any of you will answer that. Do you think we're in enthusiasm? Do you think we're more towards the euphoria? Do you think we're in a bull trap? Where do you think we are right now? I'd be curious to kind of know your thoughts. If you notice, I'm making this very interactive, right? All right, we got one vote for bull trap and return to normal. Yeah, if you depending on how long you look at this, right? I know right now we're seeing the market as of today starting to go down a little bit, but we've seen some little dips, right? Especially when we had little issues going on. Got another vote for bull trap. Yeah, I could definitely see why. So awesome. I love these comments, and I know more of you guys are coming in with these comments. Personally, I mean, I've debated this back and forth. I think you could be right. It could be a bull trap, but usually a bull trap is when the market comes down and then it pops back up to normal. I wonder if we just passed that bull trap. Either it's one of two things, in my opinion. Either we're at about the point of the new paradigm, right? Because it is very euphoric. I'm going to talk about why that's a problem in the stock market, right? I know some people are saying like, I'm waiting for the crash. Yes, I know that's a lot of what us are starting to see right now. But there's that new paradigm, right? Now, there was April where we did see the market pull back quite a bit and then it popped back up. So if you guys are referring to that kind of bull trap, I could definitely see that. That could definitely be the case where we're getting back to normal. I mean, we're now higher than we were in April, right? We're at all-time highs, of course. So we're at the very height of the market. Usually, if there is a bull trap, and again, this could vary because you guys could be right, I could be wrong. Usually, if there's a bull trap, it does pull back. This is kind of like back in March of 2000. March of 2000, the market was hitting an all-time high after the Y2K craze, and then it pulled back. But then it started to recover up until August 2000 before it just started sinking after that point. And it came right back to equal again. So it could be like that, although we're more like here if you're looking at that's April. Again, we can debate this all day long. I think the one thing we can all agree upon is it's way too freaking high, right? And that's the thing is that today's market, it's like the Lego movie, right? Everything is awesome, right? Nothing's wrong. It's absolutely euphoric. There's no issues going on at all. Even when you hear people talking about it, here's the problem I hear today. And this is even from people that understand what we know, is that I was just at a conference and people are saying, okay, you've been talking about this for years, Chris. Even my own clients are saying it's like, you've been talking about the market crashing for years. It hasn't happened. Are you just, maybe we're all wrong. Maybe the market is the best place to be. Maybe you guys are just doom and gloom and this isn't true. This is typically what happens, is that even the people that are the most educated start to say, yeah, maybe everybody's wrong. Maybe Warren Buffett's wrong. This is when you should be most concerned, because right now the market is everything is awesome. Right now, I call it the era of dumb money. This is typically what you see at the height of the market, right? You'll see right there, the dark blue. Each year, more and more retail investors are starting to throw their money into the market. Notice the institutional investors, there's money in there, of course, because there's been liquidity, but it hasn't been increasing that much. It's been mostly really a lot of millennials and even Zoomers that are throwing money into the market right now. Here's also the problem too, is that institutional money, people that have the companies that have their mutual funds, right? Could be like various type of risk type mutual funds, large cap, small cap, stocks, things like that. Right now, they're roughly about 1% being held in cash. So they're fully invested right now. And you're seeing a lot of other people fully invested. I didn't put this chart in here, but there's also people that literally are leveraging margin accounts, which means they're leveraging debt to invest in the market. People are actually throwing debt in. I will tell you this, if you see the market where money's going in with borrowed money, debt is going in, that is a problem. Because once debt starts going in, once there's a lot of speculation, the AI tech boom that's going crazy right now, this always is followed by some crash, right? The manic era happened in 1929 before the Great Depression. We had Y2K that happened. We had the Great Recession where that happened as well, right? Where the craze was in the real estate space, and it even affected the stock market too, because banks started failing, right? All this stuff was happening. You got to be careful of that. So this is the era of dumb money. Check this out. This is the Buffett indicator. This is taking what are the actual values of the S&P 500, of the stocks, of the stock market, and saying, what does that compare to the actual, like real government numbers, the gross domestic product, the GDP. So essentially, how much above or below is the stock prices compared to the actual health of the economy? Notice right now, we're at like 224%. This is 124% above the mean, above where the average should be. We are about double, more than double. Notice the last time that we saw this happen, even this high, we either had a little bit there in 2022 and then the market did dip, but that popped right back up again, right? Well, of course, we've also got, if you look back, 2008, you see even 2008 wasn't that much, but Y2K was way lower than it is today. And we saw the market correct by almost 50%. How do I know? Because I personally felt it. I witnessed it. I was a financial advisor in 2001 going into 2002. I saw what happened there. You can see even this chart here. See that red line that's going on the bottom? That's a long-term trend line, as they call it. That's the line that I drew based on my stock trading experience and everything else that I've done. Notice that this is way above the line here too. So it's just showing the same exact thing. But notice, of course, the average the last 30 years has been only at 8.5%, despite the fact that we haven't even touched that line since about 2009, which is when it hit the bottom and bounced up. At what point does it start pulling back once again? Here's the other problem. Vanguard, who, by the way, they want you to believe that the stock market is going up. They're optimistic about the stock market. Notice here, back in just a year ago in 2024, they expected that the market would only average between 2.8 and 4.8% a year for the next 10 years. This means you would be better off in a CD with less risk than having your money in market. Here's the deal, guys, is that I'm going to talk about what the wealthy are doing differently right now. And this is not a popular opinion because the truth is that most people don't believe it. Let's be honest. Most people, again, are stuck in euphoria. They're stuck in bliss. All is well in Camelot. And the truth is it's not. And I know I'm getting pretty in your face about this because I'm getting sick and tired of the ignorance that's going on right now. Because the truth is that a lot of people believe that things are just going to keep going the way they've always gone. And that's not been the case. Anybody who's under the age of 40 has never even seen a market correction, not a real one. 2022 was a blip in comparison to the overall market. It barely did anything. And so they don't remember that. They just remember that whatever they put their money in grows. This is exactly what happened to me in my 20s in 2006. Whatever I put my money in grew. It didn't matter if I put it in the stock market. It didn't matter if I put it into real estate. I was making money not because I was brilliant, but because I was an ignorant, egotistical idiot. And that's the truth. Okay. Can I hear an amen? I don't know if anybody else was that way too, but I personally was that way because after 2006, we got 2007, 2008. Then all of a sudden, as Warren Buffett would say, when the tide rolls out, you find out who's swimming naked. I was one of the naked swimmers. I was one of those people that believed that I had the Midas touch. Whatever I put my money in turned to gold. That is a euphoric trap, right? So I appreciate you giving me the amen on that one. Thank you. So anyways, I'm not going to keep laboring on this, but let's just talk about what the wealthy are doing. The wealthy are selling while the amateurs are buying. The wealthy are selling right now while the amateurs are buying. What does that mean? Well, let's look at Warren Buffett. Did you know Warren Buffett actually, like he's recommended to so many people over the years, he would say your best bet, if you're not a good experienced trader, is to keep put your money into the S&P 500, like VOO, for example, right? You put into that, the S&P 500 index, it's low cost, you just keep putting your money in on a regular basis because you don't know how to time the market. So just do that. However, guess what Warren Buffett did? Sold off all of his shares of VOO, the very thing that he says that average people should do. He didn't do it. So do you follow his actions or do you follow his advice to to the overall American audience, right? Good question. How about this? Warren Buffett also last year reduced his stake in Bank of America to below 10%. He also sold off a ton load of Apple stock, the very stock that many people are buying. If you've been thinking that you're diversified in the S&P 500, by the way, did you know the S&P 500, of the 500 companies, the top 7 make up 37%. 37% of that index, just 7 companies. The top 10 brings up over 40%. You're no longer diversified. Now you're starting to see more and more people saying, maybe I shouldn't be in those kind of things. But that's what you've been taught the whole time. Safest way to go, buy that little S&P 500. Granted, over time, yes, bet on America, bet on the stocks. Yes, it's going to work over time. But where we're at right now is a scary place. Here's another thing too. Just a few days ago, Buffett had it, Berkshire Hathaway reported their earnings. They made a lot of earnings, but guess what? Almost all of it went straight to cash. And you'll see that right there. Now it's at $381.7 billion that he's got sitting in just cash or cash equivalents like treasuries and whatnot. That's where he's got his money. By the way, I know it's shaking on my camera here because I have this table at this hotel and I'm like moving it because I'm getting excited. So I apologize that there's no earthquake in Texas. Okay. Notice this too, for the 12th straight quarter, this is also important too. Buffett has been not buying, but selling more stocks than he's buying. He has been liquidating for 3 years straight. Those of you that have been following me long enough know I've been saying the same thing, although I started a little bit before 3 years ago. It was about 3.5 years ago. I said, guys, we might want to start moving to cash. Now, I know a lot of people would say, yeah, but that was a bad move, Chris. You're going to lose. Maybe not. Because here's the deal. Like Bear Bryant says, offense sells tickets, but defense wins championships. You can still be liquid with cash and still make money. Just so you're aware that this is why the wealthy are selling out right now is the same thing that Buffett did in the last few times that we saw a little craziness in the markets, right? September 2008. You guys remember September 2008 was when the same month that good old Mad Money, Jim Cramer, said, buy Bear Stearns. And then just days later, Bear Stearns tanked to zero. It went bankrupt, right? So that same month that everybody's freaking out, everybody's panicking, what did Warren Buffett do? He bought Goldman Sachs and put $5 billion into their stock, which, by the way, a lot of that stock then, of course, paid out. He also, in August 2011, remember we talked about going back to 2011, he bailed out Bank of America, put $5 billion into their preferred shares, and then even got $700 million extra of warrants and things like that. He literally was the one that bailed them out, not the government. He bailed them out, which, of course, as you just saw before, he's been selling off his stakes in that company too, just like he's been selling off Apple. May 2020, he dumped the airlines. He got out of all the airlines before they started having all that stress, right? He's been ahead of the curve. But at the time like this, when it's euphoric, nobody wants to say Buffett is a genius. In fact, most of the time they'll say he's old, he doesn't get digital currencies or assets. That's a new thing. He doesn't get AI. It's a different world. Buffett's antiquated. He doesn't know he's talking about that 94-year-old freak, right? That's kind of what people are saying. And they've said it before every time a market crashes. That's always the case. It's almost like clockwork. If you understand the psychology, we're in a place right now where people are overly confident to the point where they're not even worried. And this is when you should be the most worried. I get more worried the less people get worried. Well, now I'm not worried about my own money, but I'm worried about their money. And this is why I'm doing this class specifically for you on this topic. So here's the problem though. If you cash it out, this is the big issue I always get is people say, okay, but yeah, I get a lot of cash in there, but now I'm losing to inflation, right? Because now inflation is kicking my butt. I put it in, you can put it in the banks right now, but the banks are starting to pull back interest rates. Even our high yield savings accounts aren't paying as much. Even the CDs are starting to go down in interest. We're not seeing as good numbers anymore. So obviously we don't want cash to sit around earning nothing and lose to inflation, right? So either we let it sit there and lose to inflation in hopes that, of course, that if we lose that way, it's not as bad as losing to inflation and losing into the stock market. That's what happened with my dad, for example, 2000 at the height of the market. It crashes. It comes back to the very same high it had in 2000 and then crashed again in 2007 and started heading back down. The problem is by the time it got to about 2013 or so, finally the market got back to where it was. Unfortunately, inflation also doubled during that period of time. And so for anybody who said, oh, yeah, I got my cash back by 2013 or 2015, you look at it and say, well, now it's only worth half. So this is the danger if you're in the stock market. It's just understand that earning 0% of your money is not the worst case scenario. I hope you guys understand what I'm saying there. But what can you do to not lose to inflation? Here's what I think the perfect savings would be. If I were to wave my magic wand, it'd probably be like this for you too. Is one, it's got to be liquid. I got to be able to use it for whatever I want, whenever I want, right? Like I got to be able to have access to that money because if those opportunities start popping up, I want to be the first one to jump on it. I want to be the one with cash because it's the golden rule. He who has the gold or she who has the gold is the one that makes the rules. If everybody's got their money out, right? They got it like into their Bitcoin, they got into their stocks, they're all locked up there. and they're throwing all the cash in those places, but very little sitting in cash in their bank, what happens when those markets drop? What happens when people start getting laid off, which we see more of? What starts to happen? There's less and less cash available to use. Those that have the cash ready to go, protecting it, preserving it, getting it ready, are the ones that are going to be able to make all the rules. They're the ones that are going to be like Warren Buffett, who says, hey, I'm coming in and I'm buying it for dirt cheap, right? That's how you do it. So you want it to be liquid. But at the same time, you don't want to be so liquid that somebody else can get to it. For example, what if somebody sues you? What if, of course, somebody's trying to put a lien on you or on your property, right? Things like that. What if you have creditors that pop up? Hopefully not, especially if you're liquid with cash. That won't be the case, but you never know, right? You want returns that at least beat inflation or at least keep up with it, right? Wouldn't it be awesome if it were tax-free? By the way, you don't see too many tax-free bank savings accounts here in the United States. Canada, they got them, but not so much here. And no, a Roth IRA is not quite a tax-free savings account because it's not very liquid, not in the sense that you want it to be. But you also want to be safe from bank failure. So we can put money in the bank, but what if banks fail, which happens almost every time we run into a recession, is that we start hearing more and more banks fail. And of course, wouldn't it be nice if your family could get more of it too? Now, those of you that know me, you already know that there is a savings account that does this. Some of you guys even have this already set up in place, but maybe or maybe not, you're not using it to the best of its ability. I kind of refer to this as like the Swiss Army knife that works in any market. It doesn't matter if the market time is booming or if times go bad. And especially when times go bad, this place is like the hero. And that's whole life insurance. Yes, that's right. The most boring possible insurance you can get besides term insurance. That's boring too, but whole life insurance. Now, before you just tune me out about this, we're not even talking about traditional infinite banking. I'm going to be going a little bit deeper into how I'm using this today in preparation for this very thing, right? Because I want the same thing as you do, right? I want money that's going to be available. It's safe. It's protected. Tax-free is even better because I don't want to pay taxes on the returns I'm earning on it. And I'd love to have it ready to go when time's going. Just so you guys are aware, just if I were to step off a little side note here, I'm still investing, but I'm not investing as heavily. Very similar to Warren Buffett. By the way, Warren Buffett last quarter, just last month, did buy into Occidental Petroleum, about $9.7 billion in Occidental Petroleum. But here's the thing, guys. Guess what he did? He didn't use his own cash. He actually used the cash from the insurance company as collateral. So the very thing I'm talking about right here is what Warren Buffett did literally just last month. The difference is he owns the insurance company, right? He has ownership in the insurance company where he got what's called float. Where here we talk about how you can use it. And in a lot of ways, you have more flexibility than him and how you can do it too. All right, so what we're talking about here is the max ROI infinite banking strategy and how we're going to use it specifically for what's going on. Now, for those of you that don't know what this is, right? Whole life insurance, infinite banking are not the same. Infinite banking is a strategy you use with whole life insurance. Whole life insurance does have a death benefit like term insurance does, but it also has this tax-free savings account. Now, this tax-free savings account you can use to withdraw. You can also use it as collateral to get loans, often from the insurance company, from banks, things like that. And so when we talk about infinite banking, we're talking about how do we utilize this tax-free savings account inside of it. And it's really a tax-free high yield. Because, for example, traditional savings, we know the interest rates are going down. But on the infinite banking side, it's 6% or more. We just had Mass Mutual come out with an announcement that they're raising their dividend from 6.4 to 6.6%. Now, is that everything, to know whether or not to use that company? No, that's not everything. It's not always the highest dividend that wins. It's based on costs, right? Which we'll talk about here in a little bit. One thing you also got to know, if you have bank savings, if you get sued, people can access it. Bank savings accounts are not protected. Life insurance savings is protected from lawsuits and creditors. You can literally be sued and have millions of dollars stored in your life insurance that someone cannot get to in most states. There are a few states that do have some exceptions where you can pierce that a little bit. But even then, they still have at least some minimal protection in there. Of course, we already know that the rate of return on banks stink, where we can definitely get a better return and even leverage and have more opportunity there. You don't have leverage with a savings account, but you can do bank leverage with infinite banking. You also don't have a lot of opportunity with savings accounts in the sense that you don't really know you're going to grow much. But here in the infinite banking, I'll even show you something that some of you guys have not seen before because I've added some extra little educational slides in this one specifically. So, all right, moving on. So again, don't just take my word for it. Walt Disney did this to buy Disneyland. ABC said they'll put up cash. If he puts in his own cash, he had to be liquid with cash. That's where He had money available in his life insurance. He used that as collateral, and ABC came in the rest to create Disneyland in California. J.C. Penney, during the Great Depression, all of a sudden became a lot less liquid during that time, like everybody else did. And he actually dipped into his savings account with his life insurance to then pay for payroll, right? My story is this. I learned about this in 2006. Now I'm going on almost 20 years ago from all these real estate investors telling me this is the best thing to slice bread. When they told me it was whole life insurance, having been a financial advisor that told people never to buy whole life insurance, I thought this was pretty surprising. But anyways, I started to learn it. I drank the Kool-Aid. I decided to buy my own policy. I realized it was pretty expensive. But the agent that I bought it through, because even though I had an insurance license, I didn't know how to set it up for myself. I trusted the agent, the guy that was my friend, to do it. Well, a few years later, 2008 happens, and I'm not cash flowing well. I'm in the hole each and every month. Couldn't afford to pay my premiums. When I called the insurance company, I said, "What are my options?" They said, "Nothing," because there's no cash in this tax-free savings account that you can use to keep your policy going for years and years. So if you don't pay us, like term policy, if you don't pay us, you lose it. Guys, I had paid in $25,000 into this policy over those previous 2 years, and I had zero to show for it. Just months later, to my surprise, I found out that the insurance agent that sold it to me wasn't fully honest with me. And this is why whole life insurance gets a bad rap, because what ended up happening is, he sold me the traditional whole life insurance policy. I was hoping that he would give me a policy that was great for investors, or especially as I was a business owner too, something that was more liquid with cash. It didn't have all these extra big fees. And so when I did my own research, I found out, guys, that I could have actually done it better. So I came with my own numbers prepared. Because remember, I saw an insurance license. So I went and did my own research, came back with my own numbers and said, look, I can beat all your numbers with what you're doing for clients right now, including many of my friends and family I had referred to him for them to talk to him and do this kind of strategy. And we went back and forth, argued about it. And finally, after 2 hours, he just said, Chris, I did it that way because I couldn't afford to cut my commissions. I said, well, there's the answer. That's it. This is why, guys, you cannot just go buy whole life insurance and expect you're going to get the best thing. Because every time I've tried to refer to somebody else, even though I try to trust them, guess what happens every time? They try to pad in extra costs into it to give them paid more commissions. Not more than what's supposed to be, right? But more than what I would want if I set up on myself. And then sadly, more than what they would do if they set it up on their own selves or their family members. They would give you a worse deal than what they do for themselves. And that to me is just a non-negotiable. That's not right, which is why in 2017, we started doing it ourselves in-house because I couldn't find anybody I could trust to do it consistently. So anyways, long story short, that's why I've been perfecting this method of how you can do it to where you get the best ROI every time, right? That's why we call it max ROI infinite banking that we've trademarked, because it's not like the traditional infinite banking you see out there, because that stuff is kind of a ripoff. Let me show you an example of what that means, to kind of give you real life. The vanilla whole life is on the left-hand side. This is actually a real situation. And guys, it's not just about the insurance company. This is the same insurance company. In fact, the one on the left was sent to me by an insurance agent who worked with another company that said, hey, I just got referred to this lady, this neurosurgeon. She's been putting in $60,000 a year. And I'm looking at this. Couldn't you do better than this? And I told him, I said, yes, absolutely. Now, it's kind of hard to see the numbers here, right? But let me just tell you this, the one that she had set up on the left was just like the one I bought too. So let me break it down, the differences. That left one, the traditional one, right? There is no available cash till year 3, just like mine. So she had paid in $60,000 year 1. All of it went to paying for the insurance. $60,000 more in year 2. All of it went to insurance. Finally, by year 3, she would have, by the way, she's not in year 3. She's at the end of her year 1 right now. She would only have $30,800 in cash. So she would pay in $180,000, $60,000 times 3 years to only have $30,000. By the way, she doesn't finally have as much cash as what she paid in until the 13th year. On mine, first month, not after 3 years, the first month, $50,000 in there. She put in $60,000. She had $50,000 available in cash that she can access whenever she needs it. By year 3, wasn't $30,000, it was $168,000. So even though she paid $180,000, and even though the costs are front loaded on whole life insurance, still we had $168,000 and had more than what she pays in by year 5. Needless to say, when she saw this, she was a little bit pissed off. Pardon my French, but that she was definitely not happy about this. I mean, honestly, would you? Of course not, right? This is the horrible thing. Just so you know, like even later on, some people would argue like, well, it gets better later. Yeah, it does, but still, she only has like 2.38 million after 25 years, where in mine it would be over $3 million. That means it's literally saving her in those 25 years, like not even adding more return, right? It's just about saving her those costs, saving her over $600,000 for that period of time. That's hopefully you kind of see why I agree with Dave Ramsey when he rips on whole life, saying it's a ripoff. Because if you buy the thing on the left, it is. What we do on the right makes it work better, especially if you want to have liquid cash that's working harder for you, just sitting in a bank where you get taxed on 0.0%. And yes, that's not even the best example we've ever beat. I put this little QR code if you ever want to watch the interview they did on our podcast with the Jorgensens, with Jay and Krista. Really kind of cool to see what happened in their situation too, where we literally took old infinite banking, which by the way wasn't even as bad. The infinite banking policies they bought were more like the traditional infinite banking you see out there, not the bad traditional one, the vanilla one I just showed you. Like in between mine and the bad example, they did that, and still we were able to help them increase in just 20 years by over $2.25 million more. Just same thing. Lowering the costs, which allows you to maximize your returns in those things. Is that cool or what, right? So again, you don't want that money to be stolen by agents with their high fees and costs. That's why you want the max ROI for you, not your agent, right? Now, this isn't for everyone. There are a few of you that may not qualify for this, or I would just not recommend it. For example, one, if you're on a paycheck to paycheck situation, if you're literally, you don't have extra money you're able to save each and every month or year, like maybe you can't even afford to put money in a 401k or in building up your savings account. If you're literally just paycheck to paycheck, don't do this. I would just suggest doing a simple term policy that you can then convert down the road, right? Something very easy to do that way. If you're also in bad health, if you're in very poor health, where maybe you've had cancer recently or heart attacks or strokes, maybe you've had like some really severe mental disorders or something like that. Anything that might affect your health might be hard for you to do it. However, if you have a healthier family member or a business partner, you might be able to get the policy on them instead to take advantage of that. I did have one client who literally was not in great health. He was in his mid 50s, which by the way is not too old. The other part too is if you're over the age of 70, the strategy doesn't work as well. It could still work if you're in good health, but it's not as good. But he was in his 50s, which is plenty young enough. And even his situation, I said, yeah, I can see what you mean. If you've had heart issues, this would be hard. Well, are you married? Yeah, I'm married. And my wife's 52, perfect health. Great. We'll just do a policy on her instead. He was able to save $110,000 a year into his wife's policy. And by the way, was sued, and that money's protected. So here's a big thing to kind of recap if you remember nothing else, what allows you to do this by having this liquid cash. Your money does compound tax-free at about 6% or more a year currently. It's protected from lawsuits and creditors, and it's always guaranteed to grow. In fact, a lot of the companies we've used have been paying more than their minimum guarantee since the 1840s or 1850s. Guys, this is literally when Abraham Lincoln was still losing elections. These guys were paying each and every year through civil wars, world wars, depressions and recessions, you name it, no matter if it's Republican or Democrat, no matter what you think the world's going to go to complete, in a handbasket, right? Whatever you think, this has always been paying out above their guaranteed returns. I kind of have a nice little chart. You can actually find the same chart on moneyripples.com. But the biggest thing is this, is that one, better returns consistently. Like I said, they're paying about 6%. One company, they pay between 5.75 and 6.34 for the last 20 years. So very low, like very small range of change. By the way, the higher the interest rates go, the more you get paid. The lower interest rates go, if they go back towards zero, yeah, you might get down back into the fives again, the 5% range. Contribution limit, this thing is really cool about this, is because 401ks, Roth IRAs, you have limits there. But with this kind of plan, you can put in up to 25% of your stated gross income. 25%. So that means I just talked to a dentist last week. He said, well, let's say I'm making $1 million a year. He's like, Chris, does that mean I can put in $250,000 a year? Yes, it is. That's what it means. Where a lot of times people, even with Roth IRAs, in my case as well, like many of our clients' cases, if you make too high of income, they wouldn't even let you contribute to a Roth IRA. So you have to do the whole backdoor Roth pain in the butt, right, to do that. This doesn't have that problem. You don't worry about making too much. Fees, by the way, are more based on what's the actual insurance costs, right? There's not like extra surrender charges. Somebody asked me about that yesterday. No, it's just based on insurance costs, simple insurance costs and whatnot. If you do borrow from it, there is interest being charged, but it's very low. You can get access to funds. Now, here's why I still use a bank, because if I need money today, I can walk into the bank and get that money in cash in my hands right away. Here, it might, at worst, roughly 5 to 10 business days. Usually it's within a week, you can get that money transferred to your account. Unless there's holidays, or craziness going on in the marketplace, something like that, it might take, a week and a half or so. But for the most part, you usually can get your money in about a week or less. You can also use money while you're growing. I want to talk about that in a little bit. Asset protection, I already mentioned, you get protected from losses creditors, where that's not the case with high yield savings account, but it is the case with 401k. That's the only place it's protected. But again, you also have that money locked up from you too, so you can't get to it. Tax brackets, tax-free growth, much like a Roth IRA, it grows tax-free, comes out tax-free. You use after-tax dollars to fund it. Zero market risk, which is the important thing we're talking about today. And we don't have to worry about FDIC, where FDIC is kind of broke in comparison to where the bank deposits are today. If we were to have a big run on the bank, FDIC would go bankrupt, right? You would possibly be waiting for your money. With life insurance companies, give you an example, in the Great Depression, even when things got bad, banks in 1929, there was 35,000 banks. By 1935, it went from 35,000 down to 13,000 banks. So we lost about 60% of banks during that time. Insurance companies, about 20 failed during that time. And so even in this case, where there might be the rare off chance that these companies would fail, like I said, most of these companies have been around since pre-Civil War, or many of them have. The great thing is that even if they do fail, there's reinsurance companies that are global insurance companies that back them up. So if that company does happen to go out of business, the other insurance company takes control, protects your cash and your death benefit too. So you have all that protected. Here's one of my favorite things, government control. Well, one of the things we're kind of unsure about lately, we've got the government shutdown going on right now, right? That's always fun, of course. We still pay them for that. But that government shutdown, as an example, government changes the rules. They pass new laws. In 401ks, IRAs, you have to go with whatever the law is at that time. You have no say in the matter. Same thing if they do happen to change things with banks, although they usually don't do it too much, right? But with insurance, whatever the tax rules are when you buy it, you're grandfathered into it. So even if they change the rules later on, you don't have that danger, right? So that's one thing I love. This is why people say, why might I use a Roth IRA set up on my grandchild who's just born? I said, well, don't you think the government might change some rules in the next 60 years? Oh yeah, guaranteed. Why would you entrust your money, lock it up in a prison like that, where the government, who protects their own self-interest, not so much ours, would have full control of it? That to me just doesn't make a lot of sense. It's also why I don't like 529 plans for college savings accounts and stuff. So here's the thing. It's more than just a savings account, right? You can do so much more. One, I keep my collateral there, meaning I keep my savings account, my emergency fund, and in other funds too. I build up my cash here. This is my war chest. It's not only my cash for my emergency fund, because why keep my money in the bank for emergencies, all of it there? If for example, my wife wants to have $400,000 liquid for our family, the problem is that $400,000, right? If it goes in the bank making 0.1%, I make $400 a year, and then I get taxed on that $400. But here I earmark about $300,000 in my life insurance that grows at 6%. That means I'm making $18,000 a year tax-free. And yeah, I might still have like another $100,000 in the bank making that 0.1%. So I make $100 over there, but I'm making literally thousands of $1,000s more over in my life insurance than I will just storing it there. Even if you did nothing else, even just moving your money over, whether at once or gradually, moving that money over into a policy could put you in a much better position. And that's why I keep my emergency fund there. Collateral, one thing I talk about with collateral is not just collateral because you can borrow against it, but I've had people actually go and buy real estate properties using this as collateral to get dirt cheap interest rates. I had one that actually got his interest rate down to 3.75%. And this is when the going rate was about 6%. So he was able to get like over 2% less because he used this as collateral for a building, bringing his payment down significantly. And then a year and a half later, refinanced it by taking the lien off. Actually, he didn't refinance it. He kept the loan the same, but took the lien off of his life insurance because the building was now worth enough to be able to house all that money that he borrowed. Kind of a cool strategy. Kid savings. I had so many people are asking, yeah, but what if my kid doesn't go to college? Because college seems like a ripoff nowadays. What if they do something else? What if it's more of an apprenticeship? What if they want to go into business, whatever else? Great. Why not save money in here where, once again, it's not required that you have to put it like a 529 plan. If you do not use it for college savings, the problem is that they're gonna slap you with little penalties and things like that, or little taxes if you've got tax advantages and things of that nature, if you don't use it for college or for some qualified type of expense. Yes, there's Coverdell and things like that too you could be using, but here again, tax-free benefits, and I've got full control. It doesn't have to be used for college. It can be used for whatever we want. And here's the cool thing: even if I set up in the kids' name in the sense that they're the insured, the great thing is I own and control it. They don't. So even when they turn 18, they can't just go and make a run in and pull all the money out of it like I've seen people do. No, you have full control. You can keep it in your control the entire time. You might even say later on, you might say, I'm going to wait till they're in their mid to late 20s and they're trying to get established. Then maybe I'm going to gift it to them later on. But in the meantime, I'm going to make some money off of this thing, right? You could do all kinds of things with this. Extra retirement income and cash flowing investments. Let me show you this. This is one of the slides you guys have not seen before, mainly because there's a podcast coming out to show that tomorrow. So you are seeing this first right now because the podcast comes out to explain this more in depth. But this is an example of a 60-year-old. I was doing this for a group of dentists, and this 60-year-old, and specifically, they want to see what it would be like if I put in $60,000 a year for 10 years. But then they asked to say, well, Chris, I know you don't talk about this much because you talk about using this to invest in things to buy real estate and whatnot now. But what about if I just use this as tax-free retirement? Which, again, I hardly ever talk about retirement with this, but I said, well, yeah, you could. Like, you could literally put in $60,000 a year for 10 years. Now, notice that the cash is not huge. It's like you got almost $700,000 after those 10 years. Not bad, especially for a 60-year-old, by the way. The younger you are, the better ROI is on this thing, the better returns on this because there's less insurance costs, right? But I said, but here's the cool part is that for the next 20 years, just based on if it only pays 6% a year to you in dividends, right? If it goes up in dividends, you can actually pull out more potentially. But remember, there's no market swings. So if you want guaranteed tax-free income for life, I said here, for the next 20 years, you can pull off about $55,000 a year and that's tax-free. Most people, even if they put like $60,000 a year for 10 years, even if you put it into the stock market, and maybe you might have got that sucker up to $1 million, let's just say, right? You got lucky enough that the market doesn't drop on you in the next 10 years. Well, guess what? That 600,000, if it became $1 million, you pull out 3% a year. Well, in this case, I'll even say 4% a year because they're 70, right? You can pull out 4%. Well, guess what? Now you're only pull off 40,000 a year and you pay taxes on that money. But here it's 55,000 a year tax-free. I think it's 55. Oh wait, it's 51, almost 52,000. Sorry, I was misreading it there. Still over 50,000 a year tax-free versus paying 40,000 a year with taxes on a stock market you may or may not be able to trust. That alone is a pretty big deal. But here's something that's cool. Here's a strategy that I haven't shown many people to go with that. What if, because I get a lot of people, especially they say, hey, I've got cash, but what if I want to have a safe place to store my cash now, but I don't want to just pay it in. I want to just pay it once. What if I paid $600,000 instead of doing $60,000 a year for 10 years? What if I just paid $600,000 at once? How would it do? Normally, if you did that into a policy, you would lose a ton of it in fees. But with one particular insurance company, they're right now paying 5.5% a year on kind of like a CD. So you could throw this full $600,000 in. They'll pull out the $60,000, well, more than $60,000 a year because it's earning interest. They figure out how much you end up having in interest. They pull that out each and every year for the next 10 years. Well, in this example, because they're paying you 5.5% a year, guess what? Over 10 years, because of it growing, because it's gaining interest, that $600,000 you dumped in, they're pulling out that to pay the premiums. You're not paying ever again. You just pay it one time, you're done. That's over $75,000 a year that's going in. That $600,000 becomes over $75,000 a year for 10 years. And guess what? Now that $600,000 after 10 years turns into $65,000 a year tax-free. That's a $14,000 a year improvement just by dumping that money in, letting it gain interest at 5.5%, and that's locked in for up to 10 years. And then that's the money that goes in to then earn 6% a year tax-free. So now your money is actually working the whole time. This alone, even if you did nothing else, right? This alone also would be pretty awesome. And like I said, you could be 30, do the same strategy, do it when you're 40, right? And it doesn't have to be 10 years. It could be shorter time. It could be 7 years. It could be longer. It could be whatever, right? But if you're 30 years old right now, that means at 40, you can start pulling off tax-free income. No penalties, no early withdrawal like you get with 401ks and IRAs, right? Even with Roth, where they say you can only pull out so much, but you can't pull out the gains, you get slapped with penalties. Doesn't happen here. You can access it earlier, right? Now, I had a question here. Is like, is your retirement example withdrawal or loan? That's a great question. It's both. You start to withdraw it first, and then you turn it to a loan later. That usually allows your money to stretch better, at least in this example. So withdrawal first, then loan, which ensures that it always remains tax-free. The other question too is like, how's it determine how much and how many life policies can you have? You know, I'm going to come back to that a little bit later, but that's a great question, Jesus. Thank you for asking that one. So I'm going to wrap up here, and then I'm going to go back to these questions. Here's the other way you can make money too. You can actually use this to make money in two places at once when using it to invest right now. So the last one is showing you to delay the investment to get paid later, tax-free income, which is great. But what if I can make money with it now? How can I use it if I want to say I want to save up this cash? And maybe I'm storing it for the next little bit. Again, I want it to do more than 0.nothing% in the bank, but then I want to be ready to go and invest, maybe in the next year or two, maybe as soon as then. Well, here's the cool thing. You can actually go and borrow from the policy. Now, here's the key factor that many people get confused. People will say, you got this cash account, right? We're not even worried about the death benefit. Notice I haven't mentioned that at all, really. There is a death benefit, but that's not what we're talking about here. The cash account that you have in there can be leveraged against. Now, yes, you can withdraw money out of it, but when you withdraw money out of any kind of savings, what happens to the interest you're earning inside that savings? It shrinks, right? Because you're not earning that interest anymore. It's not compounding as much. Well, what if you can leave all that cash in there? But then because you have the cash in there and because it's guaranteed, insurance companies and even some banks will say, we'll give you a 95% line of credit. So if you have $100,000 sitting in here, we'll let you access up to $95,000 of that cash borrowing from us, right? So you borrow from them. This, when people say you pay yourself back interest, that's a lie. That's a marketing scheme that a lot of these infinite banking type people taught you. But the truth is actually better because, you know, you're not paying yourself back interest, which means you don't really make anything. No, you're actually paying back towards that line of credit. You're paying it down, just like having a home equity line of credit, you know, but instead of the collateral being your house, the collateral is your cash, and you can pay back towards that line of credit. Here's the best part though, guys. The date to pay your loan back is your death. There are no monthly payments like you have with home equity lines of credit or credit cards and things like that, right? You don't have, you know, any monthly payments. They do charge you interest. And if you don't pay anything towards it, it can compound against you. And then you have a race. Say you borrow $50,000 from the insurance company, but you have $100,000 a year. Your $100,000 is compounding interest tax-free. Your $50,000, if you don't pay anything towards it, will compound interest as well, right? But if you can keep it from growing, then the interest you're paying is not compounding interest. It's simple interest, which is better than the compounding interest. This is better than paying yourself and just, you know, quote unquote, pay yourself interest, right? Because now what's happening is that you're able to always allow your money to keep growing because they keep paying you on the money that's there, and you pay back how you want. So let me give you an example. Say that you built up your cash, you've got over $250,000 sitting in your policy, and you want to borrow against that cash. Now you could use a savings account, right? But if you use a savings account to do that, and even though you're cash flowing $2,500 a month, which would be great cash flow right now, that's $30,000 a year. After 9 years, guess what? You only make $1,200 in interest after you pay your taxes on that 0.1% savings account. You know, I wish my bank was paying 0.1. They went lowered it to 0.05 recently. So yeah, 0.1 will only make you $1,200 of interest as you start to pay that $2,500 a month of cash flow going back in because you drained all your savings. But the same thing with life insurance. Even though you have interest being charged to you, even though there's still insurance costs coming out, guess what? The net return, the net interest you've gained above the interest that was paid by taking that same $2,500 instead of paying it back into a savings account, use that pay down that line of credit, $126,000. By the way, this is based on me ran on myself as a 45-year-old. So if you're younger, it could be better. If you're older, it could be a little bit worse. Either way, it's not $1,200 worse. So same thing, just way better because again, you're using that cash flow to pay down the line of credit while the compounding interest is going like this. So now you're making money inside the policy, and you've of course been making the cash flow from the properties, meaning you're now making money and returns in two places at the same time. Doesn't even count the fact that you bought that property and it's appreciating, all that other kind of stuff. This is better than just using a savings account for this very reason. Now, I will say this as a current market scenario. I'm doing this strategy less. I repeat, I'm doing this strategy less. Not that I couldn't do it, but I am focusing more of my cash building up inside my policy and not using it for this reason, because I'm not just building up that money for my own, family security for like the emergency fund, but I'm also building up for getting ready for fire sales, right? I'm getting ready for the deals to come. And so this is where I'm choosing to store it. Now, if I am investing money, I'm usually investing out of my own bank accounts, right? Where I know I'm not making much money, but I've been building up cash also in here too. So I'm investing still, but I'm investing more slowly, much like Warren Buffett was. He still bought last month, but he's buying a lot less than what he's been selling because he's building up more cash. I may not be doing as aggressively as him, but I've been doing it. So anyways, that's the thing, is that as you pay the loan down, as you pay it down, of course, you can run that loan back up, that line of credit. It always keeps going. So you can keep doing it again and again. And that's where the infinite banking comes in. It's that you're constantly moving your cash. You're running it through over and over again. Now, best way to fund, I think the first few years, use your emergency fund to fund it. Much like when many people will say, I'm going to move my money from the bank that pays me nothing to a high yield savings account, you can do the same thing. Use your emergency fund to fund it, maybe for the next few years, and yes, you can even use that same strategy I showed you where you can put in that 5.5% account, let it draw from it, that kind of thing, right? After years 3 or 4 or so, start to build it. And then anything above and beyond what you want to keep for your emergency situation, just like for myself, like where I want to keep 300,000 in the life insurance that we don't touch, anything above it, free game to use, right? That's kind of how I recommend using it. Again, you can use it for whatever you want. It's flexible. I can't determine what you do with it. You can blow it in Vegas. I just don't recommend it, right? But that's the great thing, is that's kind of the strategy I'm recommending lately. Just so you know, I have other real estate investors using this too. Like, Ron, his big thing was he just got tired of banks paying him nothing. And of course, he wanted the ability to be able to keep his money safe. He's like I mentioned earlier, he said very few insurance companies have ever gone under during those years, and they're regulated differently than banks. He wants to make sure his money is safe, that's going to be there when he needs it the most. Neil, his big thing was creditor protection, right? And then just be able to not be exposed to bank risk as well as the market risk. I had this dentist as well. He said his biggest regret is he didn't learn about it 20 years prior, which I hear weekly from people about that same thing. And the great thing is too, guys, like I said, I haven't even talked about the death benefit. You can actually use this to grow generational wealth because that money all passes on tax-free. By the way, I mentioned about the loans. Whatever loans you don't pay while you're alive, great. They just pull out your death benefit and then pay the rest of your family tax-free. So you can literally not have to pay on that loan ever if you choose to. You just have to make sure that when you die, well, you don't have to do anything. The insurance company just takes their money back for whatever you owed them, pays the rest to your family tax-free. Some people even say, hey, I might just use this instead of trying to gift my kids a bunch of money. I'm just going to disinherit them. I'm going to use up all my money while I'm alive and try to get to as close to zero as possible. There's a book even called Die with Zero, using strategies with life insurance. So a lot of different ways to do it. Here's the thing I want to leave you with, right? Is that no one cares about your cash, your savings, or returns more than you should do or should, right? So why not make the most of your money right now? Protect your money. Do not let the markets, take it all away. This could be the best time to capture. And, like many people keep asking me again and again, they're like, well, Chris, should I sell? And I always tell people, one, I'm not an investment advisor. I'm not securities licensed. I can't tell you to buy or sell stocks or anything like that. But I will say this, is that when I was a stock trader, and if I were still in the market like I used to be, for me, like I often will teach people about scaling out. Maybe you don't have to get out of the market, but maybe you want to take some chips off the table. Maybe you do want to get in safer places. Yeah, you can move that money over. You don't have to be all in on the market like everybody tells you to be. You can do whatever you want with your money. You can move it out. Could people start using that stuff to fund policies? Yeah, sure, they could. That's a lot of people do. Some people just use their available cash that's been sitting in the bank doing nothing. Some people I've been selling properties saying, I don't even know where to put the next money because I can't see any properties I like. Maybe I just throw it in here, right? There's so many ways you can do that, where again, you want to make sure you're liquid and ready with cash to go. just like Warren Buffett, who's now got over 30% of his portfolio just sitting in cash. You don't have to necessarily have 30% of your money sitting in cash, although a lot of the wealthy do have at least 20, 25%. Especially right now, you're seeing more of that happening, more moving to cash or into other alternatives like real estate and things that are a little bit more safer, where they know that it tends to be recession resistant and things like that. So, all right. So you can actually go on moneyripples.com/infinite-banking. You can learn all kinds about this stuff too. You can even book a call if you want to see what that looks like for you. We actually offer you to do that as well, see if it's a good fit. If not, we'll tell you if it's not a good fit, because we don't want you doing something that's not going to make sense and bites in the butt later. Now let's get to that other question. If you have any other questions, go ahead and ask them right now, of course. I want to get back to that question that I got from Jesus here, where he asks, regarding the insurance, how is it determined how much and how many life policies can you have? Great question. So when people say, well, how much should I put into this policy? My answer is typically, here's a good rule of thumb. Whatever you've been paying into savings, and I have a lot of clients that now have stopped funding their 401ks because they realize the 401k has no tax advantage. You get the deduction today, but you still have to pay later down the road. And the thing is, with the Trump tax plan, we're in one of the best tax brackets we've had in our lifetimes. So to say, oh, I think taxes are going to keep going down is kind of a naive thing to say. And so why are we delaying our taxes to a future date, leaving the 401k? So we've had a lot of people say, wait, I've been max funding my 401k with $20,000 a year. Should I put my money here instead? And the answer is you could. And by the way, now you can invest it however you want. It's not locked up and you have to go in your little Fidelity prison to pick your little, funds, like you're picking a meal plan in jail, right? Which I guess you don't really get a meal plan in jail, but you know what I mean? So yes, you can do that. So if somebody has, let's say, $25,000 a year they could be saving, I might suggest no more than doing a max contribution limit of maybe $15,000 to $20,000 a year. So it's still less than what you've been paying, because if you say I could do $2,000 a month, great. Well, let's go a little bit less. Let's make it more like $1,500 a month, or $18,000 a year, or $20,000 a year. That's going in, but that's the max contribution. And depending on your age and your health, the minimum is usually anywhere from 1/5 to 1/4 of that max. So let's just pretend that you decide that $20,000 is the max you want to do per year. Well, the minimum may only be about $4,000 or $5,000. That's the required premium that needs to go in each year. So if you have a rough year where something happens, or maybe there's a delay in getting paid or something like that, and you said, hey, I don't have that 20,000, but I've got 10,000. Can I do that? And the answer is yes, because it's more than the 4,000 or 5,000 minimum. And they're like, well, wait, what if I get more cash later on? Could I add the extra 10,000 I didn't pay later? And the answer is yes, you can do catch-up contributions. But here's the key thing. You can always pay less, but you can never pay more than what you set as the limit. So if that limit's 20,000, you go a penny over that, you trigger taxes. It becomes like an IRA, and we don't want that. We want it tax-free, not tax later, right? Or tax on the gains. So just be aware of that. So we always tell you can pay less, but you can never pay more. So worst case scenario is you pay the 4,000 or 5,000. Worst case, if you don't even have 4,000 or 5,000, if you have at least 4,000 or 5,000 that's sitting in that cash account inside the policy, guess what? You can literally borrow from that policy to pay it right back in again. So it's almost like taking from savings and put it back into savings. You don't really gain anything, but you're not really losing much, if anything at all, either. Especially if it's down the road a few years, you'll actually be having a net gain of interest you're earning anyways. So that's one of the cool things. The way we design it, this is not true with most insurance policies. The way we design it, usually these things you can pay in 1 year and it could last forever. That's the crazy part. So anyways, to kind of go back to that question, how is it determined? We figure out with you is what's the max you want to be able to contribute and for how long, and then how many life policies can you have? That also doesn't have a limit either. It's all based on how much death benefit you have, which how we design it, people usually don't hit the death benefit very easily, but you can have about as many policies as you want on yourself, your family members, spouse, kids, potentially even grandkids as well. It could also be business partners. Anybody you have a financial self-interest with, you can have a policy on. Now, a lot of people will ask me, they're like, well, Chris, if I did do that 20,000 max, but then I have more cash I can be putting in, I can't put in more, right? No, you can't. But you could get a second policy and do more the next time. So you could have two policies. Maybe you start out with 20,000. You're like, hey, I love this. Let's do it again. You saw Ron on there. He started out, he's like, should I do 50 or 100,000 in the beginning? Because this is awesome. I have so much cash from day one. This makes sense. And I said, well, you can do either. Why don't you try starting with 50? And so he did, and then later on he came back and did, about 100,000 more or so, right? Like he just wanted to do more instead. So that's the thing is like, you can be very flexible with this and use it. And like I said, you can have multiple policies, again, I personally don't think you have to have lots and lots of policies. I have some people that do get one policy for personal use, one for business use. Why? Because if you get one that you're going to use for business use, not owned by the business, owned personally by you, but then you use it only for business expenses, if you borrow from it, the interest can be tax deductible. That's the cool thing. So it's just like if you have a personal credit card that you only use for business purposes, and I have one of those too that I've used, when I use it for business purposes, I write off the interest I get charged. Well, this gives you almost like a triple dip instead of a double dip scenario, right? Because not only you're able to earn more compounding interest than what you're paying on simple interest as you cycle that money through and create that infinite bank, but as well, you get the write-off that interest that you are being charged, which gives you even bigger spread on how much money you make off that interest. And you're still making money on wherever you invest it on the business side. So that's a great question. So again, when we talk with you guys, and you can see here, if you want to go to the website there, you can book a call. You can literally see what those numbers could look like for your situation. But just the only thing you have to really decide is what's the max I want to contribute, and for how long do I want that option? Because I can always pay less. I can never pay more than whatever I show the insurance company. All right. Well, great. I appreciate the questions today, guys. I know I always try to keep these about an hour or less. We just went over a little bit, but I hope this is worthwhile. If you have questions, feel free to reach out to us. But again, the big thing is right now, guys, this is your chance, right? Right now is your chance to be able to make some moves. Do you want to be like every other person that's all in on the stock market when it's at an absolute euphoric high? Or do you want to be the person that's going to be the one that everybody says, man, you were so lucky. I wish I had cash then. That's my challenge to you guys is, get your money lean, get it liquid, and then you'll have the ability to get it out to invest in things that most people cannot get into. So guys, thanks for your time. We'll see you later.